Diggers, Chinny here. I have a quick update for you. Just want to kind of bring you behind the curtain on a phone call I just had with one of my close friends who's been in real estate for a very long time. He underwrites a lot of the deals that these institutional buyers are picking up. Basically, he takes like a grouping of single-family homes that have been packaged that are cash flowing. He analyzes those before they'll buy them. And we were talking about what's happening in the markets now and what we call these peripheral markets. There's a distinction or a difference between a trophy market and a peripheral market. I'll define the two. The trophy markets are the markets that a lot of they have national demand and international appeal. So there are your markets like your Orlando's, Miami, Fort Lauderdale, your Las Vegas, your Phoenixes, your Palm Springs. Those are what we call trophy markets. The trophy markets are like some of the worst places to invest right now. I mean, you obviously have little pockets where you can find deals, but if you're doing any kind of volume and you're financially driven, you're looking for financial performance, growth, safety, and yield, then those are very difficult markets to play in. So you see now a lot of us playing in what we call the peripheral markets. The peripheral markets are lesser known markets. The Memphis, Tennessees, your Charlotte, your Atlanta, Georgias, your St. Louis, your Indianapolis, your Pittsburghs. These markets are less known, but better performing markets in a lot of cases, because you have a lot of times better economic fundamentals. You have prices that are relatively lower compared to the local rents. You might even have higher incomes compared to local prices, so you have a lot more growth potential. Basically a softer ceiling for price, but a very hard floor. So in these peripheral markets, here's what's happening right now. You have those institutional investors playing in the trophy markets first. They pick those things apart. You're talking companies and groups with billions of dollars that are buying single-family homes. They're driving the prices up. They're squeezing those yields because the rents aren't going up as fast as the prices are, and then they exit those markets when they can't meet their yield requirements because they're completely yield-driven. So now they're in these peripheral markets, and they're playing with the mom-and-pop real estate investors like you and me, and they're pushing us out of the picture because they're coming in and overpaying for houses because they don't care that the 3 houses on the street sold for $10,000, $15,000, $20,000, $30,000 more than the one they're buying, or I'm sorry, less than the one they're buying, because as long as they can buy that house and put the rehab money into it, get into the hands of a property manager and meet their yield requirement, they're picking that house up. And so they're putting a lot of pressure on the property prices. The property prices are going up, and the rents, again, we're starting to see this happening in these peripheral markets now. The rents aren't keeping up with the purchase prices. So what's happening is, here's the interesting phenomenon. They are driving the prices up so much now on the resale inventory. Remember, in the end of 2009, beginning of 2010 through parts of 2011, you had a lot of inventory in a lot of these markets. It's all been depleted now. Sometimes in cases where you have like 14 months of supply down to maybe in Atlanta market right now, we have about 6 weeks of inventory for the stuff that we're looking at. It's hyper competitive. Properties are selling for a lot more than they're being listed for, multiple offer situations all over the place, short sales, bank-owned properties, even at the courthouse auctions. It's hyper competitive because we're playing with these billion-dollar firms. So what's happening is all of the land that was out there that builders stopped building on back in 2007, 2008, these builders, you have to keep in mind, have been very inactive the last few years because you had so much resale inventory at a low cost per square foot compared to what they could build and put a house out there for brand new and make a profit on. So they've been inactive because they can't make money with all that resale inventory. Well, now that resale inventory is gone, and those resale price per foot has been raised up to where the new construction, a builder can come out of the ground and know that they can sell these properties very quickly to end buyers, or in some cases even these institutions that are willing to contract these houses before a shovel even goes into the ground. So with that being said, the opportunity now is to get a house, a brand new construction house, that is only maybe $10,000 to $15,000 more than its resale equivalent, but it's in completely perfect shape and has a lot of times a builder warranty in place, so you have a lot less headaches as far as maintenance goes, and they yield just as strong, if not stronger, than that resale inventory. So you're going to see me play with more new construction now because we have the same yields and we have lower maintenance and a lot less risk with those types of properties, and in a lot of cases we can get them in nicer neighborhoods. So I just want to kind of share that with you, give you kind of a feel for what's happening in the climate in these peripheral markets if you're a cash flow residential investor. And hopefully, as I uncover and continue to validate some things with these emerging markets, I'll be bringing those to you. And a lot of times you're going to see those with new construction inventory because the resales in there just don't make sense to try to fight for. We'll end up doing a lot better on the growth side and on our yields if we're playing with the newer product. So I just want to kind of give you an update on the climate here. I'll catch up with you real soon as I continue to get more feeds like that.